Welcome to This Explainer. Today, we're taking off our day trading hats and putting on our fixed income strategist hats. We are building a quant model deep dive on the single equation that governs PLAZM's long-run supply economics. We're stepping completely away from the daily noise and looking structurally at the mathematical foundation that determines whether this protocol acts as a depreciating or an appreciating asset over time.
Disclaimer: this content is for educational and informational purposes only. It is not financial advice. Cryptocurrency investments are highly volatile and carry substantial risk. Always conduct your own research and consult a qualified financial advisor before making investment decisions.
Okay, here's our logical progression for today's structural analysis. We'll start with the near-zero frontier, compare burns versus scheduled emissions, establish the mathematical supply invariant, and then stress test the model. Finally, we'll project long-term supply and look at the dynamic between our supply floor and the demand variable. Section 1, the near-zero frontier. Let's dive right into the core equation, dictating the protocol's fundamental direction. The entire long-run thesis of PLAZM literally hinges on one specific decay curve. Every single day, like clockwork, the protocol's scheduled emissions decay by this precise, hard-coded amount, negative 0.08%. So if we compound that over the 222 days the protocol has been live, the daily emission magnitude has already fallen to roughly 84% of what it was on day one. You know, this isn't just some marketing narrative. It's a structural reality written permanently into the code. Now, the absolutely critical convergence point here is what we call the near-zero frontier. This is the exact threshold where daily scheduled emissions fall permanently below the daily buy and burn deployment rate. And guys, as of day 222, we have officially crossed this frontier. Crossing this line makes it mathematically impossible for the protocol to structurally dilute holders through emissions, regardless of macro market sentiment. The supply equation has effectively and permanently inverted. Section 2. Burns versus scheduled emissions. We need to quantify exactly what this looks like right now in terms of actual dollar inputs and token destruction. So looking at the internal routing, out of the $430.03 daily yield, the protocol routes 65% directly to the buy and burn stream. That translates to roughly $280 taking PLAZM straight off the open market and sending it to a dead address every single day. The remaining yield funds the grow and build streams. And remember, this is built entirely on a contribution never fee model, meaning this engine runs on internally generated yield, not by extracting fees from users. This brilliantly illustrates the protocol's elegant stabilizer mechanism. At a price of just 1 cent, that $280 daily burn deployment equals roughly 28,000 tokens burned daily. The burn rate in tokens is inversely proportional to the token's price. So what does that mean? It means falling prices automatically accelerate token destruction. It is a built-in mathematical counterweight to downside volatility. Over the next week, the protocol schedules an average of just 7,237 tokens released per day. Compare that tiny drip to the massive 28,000 tokens burned daily. We are mathematically running a 4-to-1 deficit. For every 1 token entering circulation, approximately 4 are destroyed. And honestly, it gets better. Because over the next 7 days, 5 of those days actually schedule zero emissions. On those days, the deficit is mathematically infinite. Section 3, the mathematical supply invariant. This brings us to a crucial point, summarized perfectly here by the protocol's lead, AJ. Take a second to really let this invariant sink in. Because the supply equation has inverted, every single token bought and burned automatically increases each remaining holder's percentage of the total supply. You don't actually have to buy more to own a larger fraction of the network. Fractional ownership grinds relentlessly upward for anyone who simply holds. And this is fueled by the recursive loop that strengthens the entire system, the buy and grow engine. The protocol reinvests 20% of its daily yield, which is about $86 a day right now, into purchasing new DexFi bonds. Right now, that buys 2.38 new bonds daily, or roughly 870 bonds a year. Those bonds generate more yield, which funds more buy and burn pressure. This is a sentiment-independent compounder. It relies purely on internal contribution and never ever requires outside capital to strengthen the per-token economics. Section 4. Stress testing the model. Now, as measured fixed income strategists, we can't just look at the rosy scenario, right? We must steelman the bear case. We have to ask, what genuinely threatens this structural certainty? The most direct vector is a catastrophic, sustained Ethereum crash. Since the protocol's vault holds roughly 211.79 ETH and the bond APR is tied to the vault's USD value, a collapse in ETH is the genuine tail risk we absolutely must model against. But look at exactly how resilient the decay curve makes the protocol across these different scenarios. If ETH goes up or stays flat, burns vastly exceed emissions. We expect that. But look at that bottom row. Even in a sustained 50% crash in Ethereum, where daily yield roughly halves to $215, simulated burns still exceed scheduled emissions. The decay curve has suppressed the emission side so drastically over the last 222 days that the burn side continues to dominate even at half its current dollar volume. That is incredible structural strength. Section 5, Long-Term Supply Projections. Let's project this exponential decay curve forward into the long tail. If we project the raw power of that negative 0.08% daily decay, by day 1000, daily emissions fall to approximately 45% of day 1 levels. By day 2000, they drop to roughly 20%. What this means in practice is that our current 4-to-1 burn-to-emission ratio doesn't just hold steady, it mathematically widens. As emissions asymptotically approach zero, that ratio is going to stretch into double digits. And this drives the cumulative supply ratchet. Today, a full 20% of all PLAZM ever issued has already been burned, gone. By removing approximately 0.21% of the remaining supply every single day, we project hitting the 25% burned milestone in just 2 months. Within 10 months, 40% of the total supply will be gone forever. This isn't a guess, it's a mechanical, deterministic reduction of supply. Section 6, Supply Floor Demand Variable. To wrap up this quantitative analysis, we firmly need to separate the mechanics we can measure from the human sentiment we cannot. The contrast here is pretty stark. On the supply side, the system is completely locked. It is deterministically reduced by the hard-coded decay curve and a yield-funded burn engine that frankly does not care about market sentiment. Conversely, the demand side remains the unpredictable wildcard. It relies entirely on daily sentiment, variable entries, and unpredictable human behavior. So, I will leave you with this final provocative thought. The math proves that the supply is shrinking mechanically. So whether you are ultimately bullish or bearish on this model depends entirely on how you answer this one specific question. Do you believe demand will eventually meet a structurally, irreversibly smaller supply? Disclaimer: this explainer is for educational and informational purposes only. It is not financial advice. Cryptocurrency investments are highly volatile and carry substantial risk of loss. Quantitative models are simplifications of complex systems and can fail at extremes. Never treat them as predictions. The author of this content has a personal position in PLAZM. Always conduct your own research and consult a licensed financial advisor before making any investment decisions. Never invest more than you can afford to lose. Past performance does not guarantee future results.